What's up, everybody? Nate here. So Federal Reserve Chairman Jerome Powell just had a huge meeting before the House Representative Committee in Washington. And he basically laid out the brand new plan that the Federal Reserve is going to take starting this March on inflation and monetary policy in the United States. In this meeting, Chairman Powell said that he is highly uncertain about the United States economy due to the crisis that is currently ongoing in Russia and Ukraine. But with that being said, he still thinks the Federal Reserve needs to raise its benchmark interest rates starting sometime soon. And he added that the Federal Reserve still believes that inflation is going to be a lot lower in 2022. So with Federal Reserve Chairman Jerome Powell having his meeting before Congress today, I wanted to take a minute to talk about everything new that he said and the Federal Reserve is now saying about monetary policy and inflation in the United States and what that is all going to mean for our economy in the future. So stick around to learn everything you need to know about the Federal Reserve and its new plan to fight inflation in 2022. But before I break all of this down, do me a quick favor and hit, smash, or destroy that thumbs up button below and ring that notification bell too. Both of those two things are completely free and they help to show me that you like this video and that you want to see even more just like it. Thank you so much for doing that. And now let's talk all about Federal Reserve Chairman Jerome Powell, the Federal Reserve, and inflation. So I want to start by reading you a few quotes from Jerome Powell himself. During his meeting with Congress, Jerome Powell said, quote, "The implications of the U.S. economy are highly uncertain, and we will be monitoring the situation very closely." He also acknowledged the entire situation of Russia invading Ukraine and said that it was a tremendous hardship on the world in general. He then went on to say, quote, "The near-term effects of the U.S. economy of the invasion of Ukraine, the ongoing war, the sanctions, and events to come remain highly uncertain. Making appropriate monetary policy in this environment requires a recognition that the economy evolves in unexpected ways. We will need to be nimble in responding to incoming data and the evolving outlook." He then went on to say, quote, "We will use our policy tools as appropriate to prevent higher inflation from becoming entrenched while promoting a sustainable expansion and a strong labor market. We have phased out our net asset purchases. With inflation well above 2% and a strong labor market, we expect we will be appropriate to raise the target range for the federal funds rate at our meeting later this month." Okay, so that was a lot. But let's talk about what Federal Reserve Chairman means when he mentions the Ukraine-Russia conflict affecting our US economy right now. Obviously, the situation in Russia-Ukraine is awful, and it goes without saying that the loss of human life is completely tragic in this day and age. But even for those who are not directly involved with the war itself, we are still being massively affected right now. And more than likely, the strain on our economy is going to last for a long time. And the reason being is because Russia holds a ton of resources within its country, and it exports things like oil and wheat and a ton of precious metals. All of those resources are then taken from the country and moved to places like the United States or other countries in order to be refined so we can create products. Except for that can't really happen right now because there's an ongoing war, which is part of the reason why you've seen the stock market sink over the past couple of weeks. Investors are still trying to figure out how long this crisis is going to last for and how big of an impact it's going to have on our economy. At the moment, Jerome Powell doesn't believe that the war in Ukraine is going to have a huge impact on our US economy. But like he said, he's just really uncertain right now, and the Federal Reserve is uncertain too. And they have to be very careful with their monetary policy right now because they can't go overboard and cause even more problems in the United States. With all of those resources having a much harder time getting over in the United States, well, businesses are gonna naturally suffer. They're not gonna be able to make as many things, which means they can't sell as many things either, which means consumers can't buy as much. That's gonna hurt profit and revenue, so businesses are gonna have a lot less of everything. More importantly, just because of that conflict, we're starting to see inflation go up every single day. In the energy industry in particular, oil prices are going through the roof. As of recording this video on March 2nd, 2022, the going price for a barrel of oil was around $110. And some experts are saying that it could go as high as $120 or even $150 a barrel, depending on if this war in Ukraine escalates. And of course, it's all of the sanctions that the United States is putting on Russia right now. So Russia is not able to send any of its money worldwide. It's not able to get US dollars, which companies in this country use on an everyday basis. Not only that though, but we've seen an entire slew of companies start to stop production and the sales of their products products in Russia itself. And even though the Russian market isn't huge for every single business, it's still a part of the world, which means there's sales to be had there and companies are just not going to get those right now. Which means that the Federal Reserve and Jerome Powell need to keep all of this in mind when they make their monetary policies. And it looks like Jerome Powell understands that, but he doesn't really think that that's going to have a big impact on what the Fed does next. There are two big things going on at the Federal Reserve right now: their benchmark interest rates and also their quantitative easing program in the stock market. Since about March of 2020, the Federal Reserve has been pumping hundreds of billions of dollars into the stock market. They've been purchasing corporate bonds and mortgage-backed securities and even a lot of treasury notes every single month. And the reason for that was to lift the stock market up and allow it to kind of thrive in an economic environment that would normally crash it. But as of around November or December 2021, they've been slowly pulling back a lot of that money. They've essentially been tapering off the amount that they've been purchasing every single month. And now in March of 2022, they want that program to be completely over with. And at this time, they are still expecting to end that program this month. As like I said, the program is nearly completely phased out. And the reason that the Federal Reserve is deciding to end the program now is because they believe that our economy is in a really solid place to do so. In addition, they don't want to see inflation go up even higher than it is right now. And back in January 2022, inflation hit around 7.5%. That's an over 40-year high. And while the Federal Reserve hasn't exactly printed $9 trillion and pumped that money into the stock market, those companies still have access to a ton of that liquidity. They're able to make business decisions and expand their companies, all because of the Federal Reserve. I mean, $9 trillion is a ton of money. That's nearly double the economic stimulus that the United States government printed during the highest points of the pandemic back in 2020 and in parts of 2021. And now Powell expects all of those investments that the Federal Reserve has made, whether it be corporate bonds or mortgage-backed securities, to essentially just roll off starting in April 2022. So the Federal Reserve is not going to reinvest any money that they get from dividends or interest. It's going to take a long time though, because the Federal Reserve bought assets at a faster pace than they ever have before in US history. Which means again, there's going to be kind of a tapering period that we're going to see from the Federal Reserve and the stock market. So a lot of that money is going to continue to exist for several months, even after the Federal Reserve stops its program. And finally, let's talk all about interest rates. So since about March of 2020, the Federal Reserve has had its interest rate at around 0%. That allowed millions of Americans to go out and spend money really easily. And that led millions of Americans to go out and get loans. It's part of the reason why the housing market has exploded over the last 2 years. The auto market eventually followed suit and our economy exploded. We actually ran into a recession in 2020, but we came out of that recession faster than we ever have in American history, all because of money printing. But with everybody buying so much and it being really easy to go out and spend money, that created supply chain issues. So now suppliers, producers, and businesses couldn't keep things on the shelves fast enough. That ultimately signaled to businesses that they need to produce a lot more things. And to do that, they're gonna have to take on some additional costs. All of that meant inflation went up. And now the Federal Reserve wants to start raising its interest rates to eliminate all of that demand in our country. They don't want it to be super easy to go out and get a mortgage or an auto loan anymore, or any type of loan. They want it to be really hard to spend your money, not impossible. Americans are still gonna go out and spend money, but they wanna make it difficult. That in itself will kind of rein in inflation, because if people aren't spending so much money, then that signals to businesses, well then the amount that they're producing is enough. And the thought is that inflation will then start to decrease because you'll have an equilibrium in the market. Now the big question on investors and financial experts' minds for the past few months is how much the Federal Reserve is going to raise its rates by. Most experts and investors believe that the Federal Reserve is way behind the curve when it comes to inflation. A lot of people thought that the Fed should have stepped in a long time ago in order to decrease inflation in the United States. But we finally have the first hint on how the Federal Reserve is going to move come March 15th, when they actually decide their next big monetary policy moves. Jerome Powell said that he would support, and he thinks it's appropriate to move its interest rates up by around 25 basis points starting March 15th. Now that's a pretty basic move, but it's actually a lot lower than what investors and experts were thinking on Wall Street. What that essentially would show investors is that the Federal Reserve plans on taking a super slow and steady approach when it comes to inflation. I will mention here that Jerome Powell said that he would be open to the idea of getting a lot more aggressive if he starts to see inflation continue to get worse in our country. He hasn't really elaborated on what aggressive would be yet, but we have to imagine that it would be over 25 basis points. So that could be 50 basis points, 75, or even a full base point hike every single meeting from March 15th. I want to read you two more quotes from Jerome Powell here. On the topic of inflation, he said, quote, "We understand that high inflation imposes significant hardship, especially on those least able to meet the higher cost of essentials like food, housing, and transportation." He then went on to say, quote, "We know that the best thing we can do to support a strong labor market is to promote a long expansion, and that is only possible in an environment of price stability." He also called our labor market in the United States extremely tight. Okay, so let's kind of unpack that. So when the Federal Reserve talks about the labor market, what they're interested in is maximum employment. They want as many people in the United States that are able to work working in our country. The idea here is that way every single person has a paycheck and everybody's getting paid, so hopefully they can afford to buy more things. And if every single person in the United States is working, then there's a lot less variables, because if you have, for instance, it's never been like this, but if you have 100% maximum employment would be 100% employment level. That means everybody is working, and that signals to businesses that everything that they're producing is pretty much going to continue to be that way forever. Because think about it, if there's no fluctuations and people make the same amount of money every single year, then you don't need to make a lot more products. Prices can remain stable then, and that's also what he's looking for the long-term expansion of the US. And he believes, with all of that being said, inflation is going to fall in the United States. Now, it's still a little bit ahead of the Federal Reserve's 2% estimate, but it's going to be right around that, at least according to Jerome Powell. Now the question is, will inflation actually drop in the United States in 2022, or is it actually going to get a lot worse, which means the Fed is going to have to get more aggressive? Well, I think in the short term, inflation is most likely going to get higher. Really, nothing has changed between last Federal Reserve meeting and right now. Everything is still pretty much the same, except we have a war between Ukraine and Russia. That's going to send a variety of different things up even higher. And what you have to consider here is the idea of the difference between the consumer price index for all items and then the core inflation numbers. Core inflation is the gauge that the Federal Reserve uses when it measures how high and how bad inflation is getting in our country. It essentially strips out all of your volatile industries, so energy and food are not going to be included in that index. So for instance, core inflation for January 2022 was around 6%. That's about 1.5% lower than the entire index in general. So when the Federal Reserve talks about reducing inflation and their target for 2% inflation, it's not really clear whether they're referring to the entire index or just the core inflation. The problem with just looking at core inflation, though, is energy, like gas and electricity, and food, like your grocery bill, are all things that Americans purchase and use every single day. Americans can't exactly ignore those inflation numbers. Those are the things that are probably going to get a lot higher in the short term because of the Ukraine-Russia war. Russia is one of the biggest suppliers in the world of oil, and they've pretty much blocked a ton of it from getting to the United States and a lot of Western countries right now. That has meant the price of a barrel of oil has gone from around $90 to $94 a barrel all the way up to $110 in just about a week and a half. Meaning gas prices at the pump are going up right now by around 30 to 60 cents everywhere. That's stretching American budgets even thinner. And of course, Russia is also a major producer of wheat. So anything that has to do with wheat, which is kind of a lot, is also going to go up in price, hurting Americans and their wallets even more. So if that conflict continues for several months in 2022, we could see prices go up like crazy, which means your CPI that's released every single month that measures inflation is going to continue to go up. The next CPI report comes out on March 10th, 10th, 2022. And some experts believe that inflation could hit around 10% in March or April of this year, all because of the Ukraine-Russia crisis. However, in the long term though, if that conflict doesn't go on as long as a lot of experts believe it will, well, that could actually be better financially for the entire world, including the United States. Now, it's not going to go down a whole lot because even before this whole conflict started, gas was still trading at around $80 to $90 per barrel. It's higher because demand for it right now is a lot higher in general, and OPEC was starting to kind of up its production of oil, but it hadn't reached demand in 2022 as of yet. This whole situation is just going to make it even slower because OPEC right now and all of the nations that produce oil are not really able to make as much as they would like because of the Russia-Ukraine conflict. So even if that does end in the long term, they're still going to be behind. So oil prices are still probably going to be a little higher for the remainder of 2022. As the United States, though, starts to reach maximum employment and wages kind of settle down, you'll start to see inflation go down too. Because naturally, people have kind of reached their cap for buying things. Now, the last thing I want to mention is all about interest rates. If the Federal Reserve only raises their interest rates by around 0.25%, well, that might mean we're going to continue to see a hot housing market and a hot auto market this year. That's not a big increase from 0%. I mean, it shows that it's going to be a little bit harder to borrow money, but not by much. That ultimately might level out in the short term because right now mortgage rates are starting to drop in the United States after going up for a few months from the start of this year. People were kind of anticipating the Federal Reserve's moves, but because of everything that's going on in the world right now, rates are going down. Banks and financial institutions want people to buy homes. They want that constant income coming in. So they're starting to get a little risky and they're dropping their rates again. With the Federal Reserve raising their rates, well, it might mean that everything kind of levels out. And that could be for just about every industry. So what you need to know is inflation is really not going anywhere anytime soon. And in the short term, it's probably going to get way worse. Number two, the Federal Reserve is still probably going to raise its benchmark interest rates in March of this year, but it's going to be very slow in doing so because it doesn't want to completely tank our economy. It wants it to be harder to spend, but it doesn't want it to be impossible for people to spend their money. And finally, for investors on Wall Street, expect that quantitative easing program to be completely phased out this year and the Federal Reserve to just roll off all of its assets and not reinvest them. All of that money is going to disappear from the market, which means investors are not going to get risky with all of their assets anymore. They're only going to buy things that make sense and hold them for the long term. So the stock market is going to be kind of shaky for a while too, but we shouldn't see outright collapses like we did back in March of 2020. But now I want to hear from you on this issue. What do you think about Jerome Powell's brand new statements on his monetary policy for 2022? Do you think that the Federal Reserve is going in the right direction in order to battle inflation, or do you think they could be doing way more to lower inflation in our country? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all of the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if video's more your thing, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.